In this podcast episode, Chris Camillo shares his distinctive approach to investing that has enabled him to generate exceptional returns over nearly 2 decades. Drawing from real-world observations, social media sentiment, and unconventional data sources, rather than traditional financial metrics, Chris outlines how he built a remarkable track record. The discussion explores his early beginnings as an entrepreneur and investor, the core methodology he calls observational investing, key examples of successful trades, his use of leverage, and his philosophy on risk and capital allocation. Throughout, Chris challenges conventional wisdom on valuation and trading while providing insights into how everyday investors might think differently about finding opportunities in the market. Chris's journey began not on Wall Street, but in the world of garage sales and estate sales, where he exploited inefficiencies in pricing collectibles and niche goods. This early exposure to arbitrage taught him to identify overlooked value by observing real demand and supply imbalances. His first notable investing insight came from noticing changing retail dynamics for Snapple iced tea at a local 7-Eleven. Realizing the impact of reduced shelf space due to incoming competitors, he leveraged his brother's brokerage account to short Snapple before the company reported disappointing earnings. This formative experience cemented his belief that simple, real-world observations could reveal opportunities missed by professional investors who were often distracted by complexity and noise. Chris's investing methodology centers on identifying meaningful change, whether in consumer behavior, culture, technology, politics, or even weather, that has the potential to materially affect public companies. He calls this approach social arbitrage investing, or observational investing. Instead of relying on valuation metrics like price-to-earnings ratios or deep fundamental analysis, he focuses exclusively on uncovering new, underappreciated information early, entering positions during periods of information asymmetry. The exit occurs when the market catches on and that information becomes widely recognized. This process involves continual assessment to determine whether the signal is truly impactful, whether it is off the radar of institutional investors, and how other concurrent events might influence the trade thesis. Unlike traditional investors who target financial statements or macroeconomic data, Chris leverages social and cultural trends that often originate outside conventional financial networks. He studies platforms like TikTok and YouTube comments for raw, unfiltered consumer sentiment, capturing shifts before Wall Street analysts are even aware. For example, he spotted the rise of bralettes, disrupting Victoria's Secret, or the viral impact of beauty influencer Jeffree Star endorsing affordable ELF cosmetics products, which preceded massive stock appreciation for ELF cosmetics. Such insights rely on understanding demographic blind spots, often related to female or youth-oriented markets, that traditional finance-centric investors overlook. Chris describes how he used Google Trends to track real-time search volume for terms like roof repair, which correlates with hailstorm damage impacting roofing companies such as Beacon Roofing. This approach gave him an informational edge months ahead of delayed insurance sector reports or formal damage assessments used by conventional analysts. He institutionalized this concept by co-founding a company called Ticker Tags, which monitored social media textual mentions linked to publicly traded companies. Despite strong interest in the technology, many top hedge funds and sell-side analysts struggled to integrate this conversational data into their models, constrained by traditional hiring biases and reliance on mathematically provable correlations. Chris candidly discusses his use of leverage, typically allocating between 5 and 10% of his liquid portfolio on high-conviction ideas through options. His trades are often aggressive, aiming to capitalize on the period of emerging awareness before a stock's price reflects new fundamental realities. This strategy exposed him to significant risks, as exemplified by a brutal loss of 1/3 of his portfolio on a single trade shortly before the pandemic. However, his willingness to double down on his pandemic bearish thesis, shorting travel and casino stocks, yielded one of his biggest wins, with returns exceeding 300% during that year. Chris emphasizes the importance of comprehensive due diligence and warns against complacency, sharing how missing critical contextual information, like franchisee revolts at Tim Hortons, led to some costly mistakes. Beginning in 2007 with $20,000, Chris claims to have generated approximately $70 to $80 million in returns, which he acknowledges sounds improbable but has been audited over the years. He attributes an average annualized return of around 75% over an 18-year span to his methodology. Despite these results, Chris reveals a key personal misstep, withdrawing and reinvesting most of his gains into early-stage venture capital investments rather than compounding his public equity portfolio. His returns in venture investing have been average, around 10 to 12% annually, underscoring the opportunity cost of diverting capital from the more lucrative observational investing strategy. The episode contrasts four broad schools of investing: passive indexing, technical analysis, fundamental value investing, a la Buffett or Lynch, and Chris's unique observational approach. While technical analysis is often dismissed as dubious by many savvy investors, Chris's method aligns somewhat with Peter Lynch's idea of using real-world observation, but without the rigorous fundamental backend. He sidesteps valuation debates completely, focusing solely on the information gap, buying when awareness is minimal, exiting as sentiment peaks. This disrupts conventional wisdom about buy and hold and valuation-driven decisions, emphasizing instead nimble, information-time trading. Chris stresses that his methodology allows ordinary investors to find alpha where institutional investors hesitate, given Wall Street's preference for correlated and proof-backed data. By exploiting conversational data, what people are talking about before transaction data confirms buying trends, retail investors can identify trends early. He argues the importance of being smart differently, avoiding direct competition with quants or fundamental analysts by carving out a niche in sentiment and behavior analysis. Although interpreting these signals requires effort and nuance, Chris encourages investors to start small and develop their own insights through disciplined observation and research. Chris advises all investors to segregate their funds into separate buckets, emphasizing the necessity of a big money account dedicated solely to higher-risk, high-reward investments. He warns against using money critical for life expenses or retirement for leveraged swings. To build this risk capital, he advocates disciplined frugality and intentional trade-offs in daily life, such as clipping coupons or saving small sums that can grow exponentially when smartly invested. He stresses that adopting this mindset helped him overcome academic and professional limitations early on and could help others access investing opportunities that seem out of reach. Looking ahead, Chris highlights AI and energy technology as key areas of interest, particularly Bloom Energy. He explains why Bloom's innovative fuel cell technology is poised to revolutionize data center power generation, offering faster deployment compared to conventional gas turbines. Despite skepticism from the broader market and fluctuating narratives, such as the futuristic notion of space-based data centers, Chris sees Bloom Energy's earnings growing robustly for several years. He also mentions his bullish view on the private jet industry, which he believes will benefit from a societal shift towards greater abundance of time and wealth, partly inspired by behavioral changes observed during the pandemic. Although Chris shares his investing philosophy and trade rationale publicly, especially on his YouTube channel, Dumb Money Live and X, formerly Twitter, he carefully avoids publishing specific trade details or portfolio holdings. He encourages followers to research and critique ideas rather than blindly mimicking his trades, acknowledging different risk tolerances and investment goals. His openness is less about providing a ready-made formula and more about inspiring new ways of thinking and encouraging investors to engage actively with the market on their own terms. Beyond personal wealth creation, Chris reveals his passion for empowering ordinary people to join the investing class as a means of addressing wealth inequality. He sees increasing access to investing opportunities, whether passive or observational, as critical to bridging the wealth gap globally. His mission is to inspire and educate everyday investors that financial independence through thoughtful, risk-managed investing is achievable even without traditional credentials or Wall Street backgrounds. By demystifying investing and promoting a mindset attuned to change and opportunities outside the mainstream, he hopes to help more people participate in wealth creation in meaningful ways.